There was a 20-year auction last week, which is the longer end of the curve. Like people are worried about our fiscal path of being unsustainable.
Get ready for a new episode of KP Talks Dollars and Cents. Learn financial literacy and get real-time updates on all things housing, finance, and real estate. So let's get started. Here's your host, Kevin Perenio.
Hey, it's KP coming to you live from Newport Beach. It's Tuesday night. We were off yesterday, obviously celebrating a great Memorial Day weekend and honoring those that have fallen. And I am going to give you a walk and talk here in Newport Beach late 11 p.m. on a Tuesday. So normally I do Monday videos and Thursday videos, but I'm going to knock this one out real quick. It's been a pretty busy day, and I had a dinner tonight. Unfortunately, I couldn't get this out earlier, but I'll try and get a Thursday night video as well. So the flow of money is interesting because last week I saw so many people talking about the volatility index, the stock market, the VIX, the MOVE index, MOVE, which is like a volatility of the bond market. It was actually kind of a light trading week because it was headed into a 3-day weekend. So what's interesting is the stock market didn't do terribly great, and neither did the bond market. And then today, both did great. And so money flowed into all asset classes. That happens sometimes on a holiday weekend when, people are short the market or they don't know what to expect. And there's uncertainty that could happen, geopolitical events, or most recently, tariff talk could impact, obviously, mortgage interest rates and money flow. And so headed into the weekend, President Trump had said that there'd be a 50% tariff on the European Union. Now, what's interesting is it's 27 nations. And, that's a lot to get together and say, what are you going to do? And there's really just 5 of them that drive kind of the decision making there. And remember, the UK is not part of that after Brexit. So, most of those 5 powerful nations don't really like our nation. So this was used as a negotiating tool to get them to come to the table. And then I think on Sunday, and then even this morning, there were some more tweets or X posts or True Social posts from the president saying, okay, that, we were going to give them a 50% tariff on June 1st, and now it's July 9th. We're going to give them some more time because they're finally setting some dates and going to make some stuff happen. So it was a negotiating tactic. There was also a 25% tariff that President Trump said he would levy against Apple just on iPhones because he's shifting from China manufacturing to India and not America. Crazy. Team Android is going to win over here if your iPhone costs $3,500, but I digress. But the bottom line is the market saw it as friendly coming into today, with the markets being closed on Memorial Day, rightfully so. And so stock market ripped, and mortgage-backed securities and treasuries did well as in addition. So mortgage interest rates came down. Huge lock day today. Now, what's interesting is there's something called the 10-day rule. So there are 10 days a year. If you take the best, remember, I am not a financial advisor. I am not responsible for your losses, only your profits. Seriously, don't take my advice. I just like talking about stocks because it does impact the flow of money. Typically, if money's flowing into stocks, it's going out of bonds, and mortgage rates get worse and vice versa. But today was one of those days where, all asset classes were going up and money was flowing into it, just like last week. Asset classes of all types had money flowing out. So the 10-day rule is interesting because it says the 10 best days of the stock market's performance. If you are not in the market, so timing the market versus time in the market is a big deal. And just kind of an interesting rule. Since 2015, if you took the top 10 days every year of a stock market's performance and you were not in those 10 days, you're like -8% return versus plus 12% return per year. That's a massive difference. So just a lesson about trying to time the market versus being in it, because you never know what's going to happen or what tweet or geopolitical event or whatever is going to happen. I mean, imagine if you were freaked out after Liberation Day and all the tariff talk, and then you missed this humongous rally that happened since early April. So it does impact mortgage rates. And now we're back in the range. We're back under this 450 range, kind of high end of the range has been 460. I think even at its worst, 10-year Treasury yield was 460 after Liberation Day. And we touched it last week again on light trading. And now we're back under 450. So, the average rate for Mortgage News Daily says we're back under 7%. Not the best, but not bad. So anyway, spring purchase season marches on. Now, consumer confidence came out this morning, and it was good. I think it was expected to be 87, and it was 97. So maybe the China deal, the UK deal, and kind of progress made since Liberation Day. Maybe it has some confidence from consumers coming back. And that's a good thing, because if there's bad consumer confidence, we've heard a lot of anecdotal evidence that people are holding off on buying a car or a house because they're not sure, they're uncertain, which is human nature. People are fearful. Here's the Back Bay. It's beautiful. We have our May gray and June gloom out here. It's almost summer. Our 4 kids will be out of school next Friday, so let the chaos begin. Anyway, it's human nature to kind of worry about things that are going on. But at the end of the day, if you need a house, you need a house. And so rates are still traditionally pretty good right now. And so spring purchase season marches on. Now, so consumer confidence is up. The Case-Shiller index came out today, and home price growth has slowed. So the Fed has successfully bent the curve. They're bending the curve. And they've been doing their job by keeping rates high. And it's meant, that home prices are slowing their growth. So that's disinflation. So it's not outright deflation. There's a difference. So, unfortunately, they only control monetary policy, not fiscal policy. So this House budget reconciliation package that passed, we're trying to bend the curve and bring our debt down and deficit, and it doesn't look like it's going to happen. So there was a 20-year auction last week, which is the longer end of the curve. People are worried about our fiscal path of being unsustainable. So 20-year long bonds and 30-year long bonds are going up in yield, right? In that 5% range. And we have a 5-year Treasury auction tomorrow, which is a little shorter term. And, if money flows into that as a safe haven, we'll see if interest rates get worse or better tomorrow. The 2-year Treasury yield is kind of one that is most closely correlated to the federal funds rate. And it's a shorter term, obviously, note. So if you think that our economy is slowing and we might go into recession, you might see money flow into that 2-year or maybe even a 5-year, maybe not as much because it's such a long time. But the 2-year Treasury would see money flow into it and rates would go down. If there was fear of slowing growth, which there's been a lot of fear of that because of tariffs, although it's uncertain if it will impact, a lot of recession estimates are down around 35%. Goldman Sachs seems to have like the gold standard of projecting recession. So, we got to watch this auction tomorrow. It does matter. The PCE comes out on Friday. That's the big one. That is the Fed's preferred measure of inflation. It's called the Fed deflator, personal consumption expenditure. It's not as heavily weighted in housing as CPI. But what's interesting about the PCE is that, we could see 2.2%. 2.2% on the headline because, oil and gas prices are down and pretty much everything except owner's equivalent rent and some of the, sorry, I got my hair windblown. Some of the other components are just down. So is labor going to break? Is it going to soften? Is the Fed going to continue to wait before they cut? More than likely. So we'll see how that all goes down. Now, I thought it was interesting. I saw Chamath Paulie Hapatia and some of the guys that do this podcast. And I saw a couple clips of it. I don't watch a lot of it, but what was interesting is they were talking about this unsustainable fiscal path and the fact that our 20-year Treasury auction was poor last week. And they were saying that we have a serious liquidity crunch. So when there's less dollars in the world, treasuries, to do business, that's usually when the Fed will want to act and cut, because things really start to come to a liquidity crunch. So we're going to keep it on that 5-year auction tomorrow. But in that same podcast, something very interesting was said is that if we just create more energy, if we create more output for energy, then the AI race can take off and we can grow our economy, which would help eliminate a lot of the debt and deficit problem. So I thought that was a pretty hot take. I would also say that, stocks have been ripping, and I don't know if we're going to see all-time highs again anytime soon, but you never know. But this whole bending the curve and this debt and deficit thing, the government spending is the biggest driver of inflation. So we'll see as the Senate kicks this bill around and tries to mess with our budget.
You've been listening to KP Talks Dollars and Cents, a top-rated show for those who want to learn about the economy and mortgage environment. Tune in each week for more episodes, and please leave us a 5-star review on Apple Podcasts and Spotify. Kevin Perenio does not render or offer to render personalized investment or tax advice through KP Talks Dollars and Cents. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. For more info, follow KP Talks Dollars and Cents on all of our social channels.